On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope everyone is well. Today we're going to talk about the housing market, a popular topic for many Kiwis and a common conversation at Friday drinks or at the barbecue or dinner party. Many of us think that we are armchair experts when it comes to house prices, and we all seem to have an opinion about what the market's doing or where prices should or shouldn't be in our area. So I will share a few thoughts about what I'm seeing and thinking out there, and as always, I welcome your feedback, I welcome your opinions. I know this is a topic that does tend to hit a nerve for a lot of people, so feed all that back to me. It's part of the fun, good or bad. Always happy to engage in the debate and to hear your thoughts. Now, New Zealand has dragged itself out of recession for now. Some people saying we might fall back into one, but for now we've dragged ourselves out of recession, and mortgage rates have also been falling for 18 months. And against conventional wisdom, that long-awaited housing market recovery still hasn't arrived, which is a little bit strange. Sales volumes have been on the up. We've seen the Real Estate Institute report a 20% increase in the number of properties sold in June. That's compared with the same month a year ago. And Cotality, which is a company that you'd probably know as CoreLogic, they've rebranded and changed their name. They are one of the foremost authorities on the housing market here in New Zealand. Got a very good team, a very good chief economist. Cotality recently said that volumes have been on a gradually rising trend for about 2 years. And it also pointed out that the rise we saw in activity during May had pushed sales levels to 5% above anything that we'd seen at that point in the year since 2016. So activity is actually up, and on that basis, the slump probably is behind us when we're talking about activity and sales volumes. But where we haven't seen a recovery is on the pricing front. The Real Estate Institute House Price Index has fallen for 6 out of the past 7 months. So nationwide prices are pretty much unchanged over the past year, and they're still a little more than 16% down from that peak that we saw in late 2021. That's not the case everywhere, of course. We've seen the South Island perform a lot more strongly. Canterbury, Otago, Southland, much more buoyant. Those regions are all within 5% of their respective peaks. I think Taranaki in the North Island also going quite well. And the impact of a solid agricultural sector is probably part of the reason for that for some of those regions. In contrast, the bigger cities, Auckland and Wellington, as an example, have really struggled, and they are still more than 20% below the levels that we saw a few years ago. The median days to sell, that's also elevated, and that does reflect a sluggish market. That shows us that properties are sitting unsold for longer. They're taking longer to sell. It rose to 50 days in June, that's nationally, and it's averaged about 47 days over the past 12 months. So that's actually the highest that we've seen since mid-2023 in terms of that 12-month average of 47. And if you remember back in the middle of 2023, that is when interest rates were rising very quickly, and the economy was definitely in recession. There was no question about that in 2023. And if you exclude that period of about 4 months, 5 months, the days to sell, the average over the last year, is actually the highest that we've seen since 2008 and 2009, and that was during the GFC. So we definitely have got a very sluggish market when you think about prices and when you think about how long it is taking for houses to sell. There are several reasons to explain that. For a start, affordability is still pretty awful, to be honest. Yes, prices have been flat for 2 years, and yes, before that, they fell almost 20% from the peak in late 2021. However, we've just got to remember that the rise we saw leading up to that peak during 2020, during 2021, that was extremely dramatic. It was about 48% in less than 2 years that house prices increased. So even after that multi-year slump over the last few years, we're still more than 20% above pre-COVID levels in terms of the National House Price Index. So there was a huge rise, and we've given some of that back, but we're still well above where we were at before all this COVID stuff and all the stimulus and all the low interest rates came about. Now, that boom that we did see in 2020 and 2021 was primarily driven by ultra-low borrowing costs, in my opinion at least. The one-year mortgage rate fell to 2.2% over that period. Now, when we look at data going back to the 1960s, there's never been a time that interest rates have even come close to being that low. And there's a decent chance that we might not see that again in our lifetime. So many would argue that prices were pumped up so much during that period that they might need to fall a little further, or at least languish for a bit longer for reality to catch up. We've also seen other costs of home ownership, rates, insurance and maintenance. They've also increased sharply, while the policy backdrop hasn't been friendly to investors either. So all of these things have created costs and headwinds for the market. Net migration has also declined much more than expected after it hit record highs in 2023, and to use a technical phrase, it's pretty much fallen off a cliff. New migrant numbers, and I'm looking at those of working age, 15 to 64. I know people work beyond 64 and under 15 these days, but in that 15 to 64 bracket, new migrant numbers were comfortably above 100,000 per annum 18 months ago. Today, they've dropped to less than 10,000. So it's a massive, massive fall. And apart from the COVID era, when the borders were closed, so a lot of people physically couldn't come in even if they wanted to, we're at the lowest that we've seen since the 2010 to 2013 period. Some of you might remember those days. It's when China was booming, the mining sector was in full flight across the Tasman, so everyone was moving to Perth and driving a mining truck for 150, 200 grand a year. It was a really interesting period. At the moment, we're the lowest since then, and before that, you've got to go back to 2000 to 2001. So migration is very low. For those of us that have chosen to stay here rather than heading to the Gold Coast or somewhere else, job security is a concern. The unemployment rate has been steadily rising for 3 years, and today it's sitting at 5.1%. That's close to the long-term average, but it's well above where we were at a couple of years ago when we hit 3.2%. So it has increased quite a bit, and apart from one quarter during the unusual COVID period, which kind of doesn't count because it was very strange, at 5.1%, that's the highest that we've seen in more than 8 years. So people are reluctant to make big financial commitments when they don't feel completely safe in their job, and that's holding the market back too. It's expected to get worse before it gets better. Unemployment likely to push a little bit higher from here, so it might be late this year at the earliest, or possibly into next year before we see any real shift in sentiment on that front. Now, nobody can accurately say where house prices will go from here. Not me, not the Reserve Bank, not any economist out there, and certainly not any real estate agent. Plenty of people incorrectly predicted the declines in early 2020 when prices ended up rising strongly instead, and just as many people have been caught out expecting a recovery to be underway by now, and that hasn't happened either. But for what it's worth, Reserve Bank forecasts suggest that prices will grow by 4.2% per annum over the coming 3 years. Now, that's a little below the long-term average. The long-term average for house prices in New Zealand, nationally, has been 5.7% per annum since 1990. So that's over the last 35 odd years. 4.2% obviously below that long-term average of 5.7. However, 4.2% is slightly above inflation, GDP, and population growth increases. But all of these headwinds, as well as a high number of listings, they really have swung the power balance in favour of buyers, including those that are on the lookout for a first home. I actually think it's a good time to buy, both for owner-occupiers and for investors. I just think that if you're in that second group, you need to be very realistic about what you're expecting in terms of house price growth over the next few years. Keep your feet on the ground. To be honest, I'm not sure if any of us should be hoping for another raging boom anyway. A stable but sluggish period for house prices could be a much more desirable outcome for the economy and for society overall. For the first time in a long while, the housing market looks to be working more for buyers than for sellers, and that rebalancing might be exactly what we need. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.